Okay, so as I said to you, we deal with a case study. Let's have a look at the fast food company and have a look at break-even analysis for two products that they have. There are two assumptions with regard to this case study. The one is that we'll sell 2 hot dogs to 1 hamburger, okay, and that the break-even is calculated on the fixed expenses only. All right. Have a look then also at the different products we've got here. We've got a selling price, which is based on competition. That's what the competition is selling the product at, hot dogs, for example. Okay, and the selling price for hamburgers is 20 Rand, and the selling price for a hot dog is 10 Rand. Now look, let's have a look at the cost to produce the hot dog for ourselves here. We've got rolls, which cost 2 Rand per hot dog, a sausage, which costs 2 Rand per hot dog, tomato sauce that we put on the hot dog roll before we serve it at 10 cents, and onion slices at 20 cents per hot dog, and a serviette at 5 cents per hot dog. If you add those up there, you receive a cost price for the hot dog of 4 Rand 35. If you have a look at the sum and the total at the top here, I've summed it together and it's those all added together. So the cost of making a hot dog for our company is 4 Rand 35. If you have a look then at the contribution to overheads, what we're saying then is the selling price less the cost price here, the selling price less the cost price, gives us a contribution towards overheads. If I push F2 on that, it'll show you the formula. It's the selling price less the cost price of the hot dog, and it gives us a contribution towards hot dogs. If we have a look at the gross profit margin then of this hot dog, we can look at what is the contribution per hot dog, okay, versus the selling price, and we receive a 57% contribution towards overheads, or gross profit margin. Let's go across then towards the hamburger. There we have the hamburger where the selling price by the competition is 20 Rand, so we feel we could charge the same price. And then the cost to produce the hamburger was 7 Rand 45. In other words, the buns cost us 2 Rand 20 each, a beef patty costs us 5 Rand, tomato sauce is 10 cents, lettuce is 10 cents, and a serviette is 5 cents. So the sum of that added together is 7 Rand 45. That's the cost of us to produce a hamburger. Minus, of course, if we take the sales price, which is 20 Rand, less the cost of producing a hamburger, we have a contribution towards overheads of 12 Rand 55. Or, in other words, a gross profit margin of 63%, which is the 12 Rand 55 divided by the 20 Rand that it costs, that we can sell it for. There's the formula there for that. So there you can see quite clearly what the gross profit margins are and the contribution towards overheads are for each of the products, a hot dog and a hamburger. So, and bear in mind, we do sell 2 hot dogs to 1 hamburger. Okay, so let's call this 2 hot dogs to 1 hamburger our sales mix. So if you have a look here, our sales mix and what are the contribution to fixed expenses, or in the other case was overheads, it's the same thing really. So if we look at it, it's 23 Rand 85. What does that mean? It means the contribution to overheads of 1 hot dog, or 2 hot dogs in fact, plus the contribution to overheads of 1 hamburger. That's the contribution of our sales mix, 2 hot dogs to 1 hamburger. So if we sold those together, 2 hot dogs, 1 hamburger, we'd be contributing towards overheads of 23 Rand 85. Now our fixed expenses are as follows. You haven't really seen these, and I'm going to tell you what they are. They are a loan from the bank. We've got to pay them back. They lent us 25,000 Rand to make our hot dog stand, and they charge us 10% interest rate, and that equated to over 60-month repayments, 527 Rand per month. Now that formula you can see on our screen right now. It's equal to PMT open brackets, and there's a formula there. I'll press F2 so that you can see which numbers are being triggered from it, but the payment formula lets you see how much your repayments would be on a monthly basis to the bank over 60 months. Now let's assume also then that you've got a stand operator, someone that works for you, and his wages are 3,000 Rand per month. So your fixed expenses therefore are a total of 3,527 Rand, or the total of those two figures together. That's what you've got to pay back monthly without any argument. They're fixed expenses in your life. The stand operator and repaying the loan back. All right. So therefore, how many sales mixes, and a sales mix, remember, was 2 hot dogs and 1 hamburger, would you be required to sell on a monthly basis in order to cover those expenses? Well, it would be the fixed costs divided by the monthly contribution by our sales mix. In this case, it's 147,87, or basically 148 sales mixes. And don't forget, a sales mix is 2 hot dogs and 1 hamburger. Look at the formula there. It's F20 divided by F18. In other words, 3,527 divided by 23.85, and it equals to 147.87. If I round that up, it's 148 sales mixes that need to be sold to make the fixed expenses that we incur on a monthly basis. Okay, so to summarize, this means that we make hot dog sales, 2 of them, for our sales mix, and 1 hamburger. So if we've got to make 148 sales mixes, we'd need to times that by 2 to find out how many hot dogs we're selling. In this case, it's 296. 148 times by the 2 hot dogs we'd have to sell. With regard to the hamburgers, we'd have to sell the 148 because it's 1 hamburger per sales mix. In this case, 148. And there you've got it. I'll show you now on the next page how we work out the break even. All right, so we now understand how many hot dogs we've got to sell and how many hamburgers we've got to sell in our sales mix in order to meet the fixed expenses. So let me take you through now to the income and expenses spreadsheet, which shows you our profitability of the company. Have a look here now. There's our sales income, okay, because don't forget we can sell a hot dog for 10 Rand, and we said we needed 296 units to sell. Let me go back there just to point that out to you again. There's our 296, all right? Back to our income statement here. And hamburgers, we said we needed to sell 148 to break even. Let's go back to the break even. There's the 148 there. So if we apply those to our income statement or our income and expenses statement, at the price of 10 Rand, we'd make sales of 296 units for hot dogs times by 10 Rand equals 2957. That's the sales for hot dogs. There's the formula. You can see it. It's D10 times C10. If I press the F2, you can see the formula applying itself there. The same applies to the hamburgers, of course. If you have a look here, you're selling the hamburgers at 20 Rand a hamburger, and you have to sell 148 to break even. Therefore, your sales of hamburgers equates to 2,957 Rand for the month of January. Okay, so have a look there. There's our sales figures coming through, and the total sales added together of the 2 hot dogs and hamburgers comes to 5,915 for the month of January, just as an example. All right. So look at our cost of sales though. These are the things that it costs to make the sale. In other words, the bread rolls, the tomato sauce, the lettuce, etc. Those are called cost of sales because without the sale, you wouldn't incur a cost of sale. So have a look at them. On our hot dogs, do you agree we had a cost of sales of 4 Rand 35? Let's just refresh our minds on that. Over here, going up to the top of this spreadsheet again over here, we've got our 4 Rand 35 here, which is the total of our rolls, sausage, tomato sauce, onions, and serviette. All right, back to our income statement over here then. There's our cost of sales for our hot dogs, and they're added up again there. Have a look at the cost of sales for a hamburger. There's 7 Rand 45. Again, from the break-even analysis, they're the costs associated with the cost of making a hamburger. Okay, added up to 745. So if I were to times my hot dogs by the units I'm selling, 296 here, by the 296 there, I'm going to have a cost of sales for hot dogs for the 296 units of 1,287. Alternatively, on hamburgers, if I sell 148 hamburgers, my cost of sales being 7 Rand 45, I've got a cost of sales of 1,102 Rand. And there's the formula there. So our total cost of sales for doing that sales mix of 296 hot dogs and 148 hamburgers is 2,388 Rand. So therefore, our sales less our cost of sales is equal to our gross profit. And then we minus our fixed expenses. And at a break-even point, our net profit should equal 0. So let's have a look here. There's our sales at the top. 5,915 for the month of January. Our cost of sales is 2,388. And therefore, our sales less cost of sales equals our gross profit of 3,527. Okay, let's have a look at our expenses. Don't forget, we're dealing just with fixed expenses here. Our fixed expenses were our loan to the bank on a monthly basis, 527 Rand. And of course, our stand operators' wages, which is 3,000 Rand. So the total fixed expenses adds up to 3,527 Rand once again. Okay, and therefore our gross profit minus our fixed expenses, which are those two, is a net profit of naught. Therefore, I've proven to you that at those units, 296 hot dogs and 148 hamburgers at their respective prices, we break even, given the gross profit margins that they contribute towards. So the gross profit margin is quite important because it contributes towards the overheads. Net profit then before tax is zero. Now, SARS doesn't expect you to pay tax if you don't make money, so you wouldn't pay tax. And our net profit after tax, therefore, at 28% would also be zero. So we've calculated now our break-even point. Now, obviously, we want to make a profit. So let's see what adjustment we have to make in order to make a profit for our organization. Let's assume we produce 350 hot dogs on a monthly basis. And therefore, hamburgers would be half of that, if you agree with that. 350 there. And have a look. Our hamburgers are half of that, 175 units. And let's have a look. Therefore, our sales income is 7,000 Rand because we're timesing it by this and adding it up there. We're looking at our cost of sales, which will have increased now because we've got more units, but our cost of sales have gone up. Our gross profit is now 4,174 Rand. And if we go down, less our expenses of 3,527 Rand, we made a profit before tax of 647 Rand. All the formulas are still the same. If we had to pay tax on that, it would be 28% of 647 Rand. Let's have a look at the cash flow then. If we opened our business with nothing in the bank, in other words, we had no bank balance whatsoever, we'd have our cost of sales, which is the cost of producing our products, hot dogs and hamburgers, and they came to 2,388 Rand, if you recall. And then our expenses, our fixed expenses, was our operator, our stall operator, and of course the repayments back to the bank on a monthly basis, and they came to 3,527 Rand. If we add our sales to that, we have a closing balance of naught. In other words, we've made no profit, there's no increase in our bank balance. But I want you to bear in mind here that we have spent some money. We've spent 2,388 Rand to produce the hot dogs and hamburgers, and we've also had to pay our fixed costs, which are 3,527 Rand. So technically speaking, we're actually down by, 5,000 or 6,000 Rand. So we'd need to have this money in our bank in order to cover the cost of sales. In other words, purchasing from our suppliers. That's if we're buying COD. Okay, so we've seen the break-even point. That's important to understand. What we need to produce in order to cover the fixed costs of our business, given the contribution of the various products we have, in this case, hot dogs or hamburgers. Let's assume we increase our hot dog sales from 296 to say 350. Let's put that in. Let's have a look at what happens here. All right. Of course, our sales will go up there because our hot dogs have gone up, and our hamburgers, don't forget, are half of how many hot dogs we sell. So they're 175. So our sales become 7,000 Rand. Our cost of sales becomes 2,826 Rand by adding those together. And therefore our gross profit is 4,174 Rand. Less, of course, our fixed costs, which are 3,527 Rand, made up of the repayment loan to the bank, and of course our payment to the stall operator. And we then end up with a net profit of 647 Rand. SARS would expect us to pay tax now, but we'd probably pay that at the end of the year. So look at our cash flow scenario if we go from there. We'd have cost of sales of 2,826 Rand, our fixed expenses of 3,527 Rand, and we'd add our income back together again, which is 7,000 Rand, and we'd make the profit, or our bank balance would grow by 647 Rand. Let's have a look then at our cash flow analysis with the new figure, the increased hot dog sales and hamburger sales. We'd have, assuming an opening balance of naught, we've still got nothing in the bank, a cost of sales of 2,826 Rand, less our expenses as well of 3,527 Rand. Those are the fixed costs. And we add our income coming in, which is our sales, of 7,000 Rand, and we have a closing balance of a positive 647 Rand. In other words, our bank balance has grown by 647 Rand. And that, in fact, ties up with our net profit before tax figure, as you can see there. Okay, now we need to bear in mind we needed something in the bank to be able to pay our suppliers. And in this case, we needed to be able to pay 2,826 Rand for the cost of sales at least. And we also needed to cover fixed expenses. So my recommendation would be that the 2,826 plus the 3,527 Rand would need to be kind of like your opening balance in your bank. In other words, you may put that in as a business owner, or you may need it from the bank itself. Let's put in then 6,000 Rand to cover those costs there. Can you see those going in? That's my opening bank balance, 6,000 Rand. Now you can see that my closing balance is the 6,000 Rand plus the profit that I made, 6,647 Rand. If we now head up towards February, that's January done, assuming our sales stay the same, we would then have the same sort of scenario happening as we go down the spreadsheet here. Okay, a similar gross profit. And so we go. So we look at our cash flow now, and we must carry forward the closing balance of 6,647 Rand to the opening balance now of February, 6,647 Rand. Less our cost of sales, 2,826. Less our expenses, those are the fixed expenses, 3,527. Add our income to the cash flow, and we would carry across 7,294 Rand to our opening balance of March. Now we're at March, and let's bear in mind that there were two assumptions with regard to this spreadsheet. The first assumption was that we would sell 20% less in the winter months than we would in the summer months. So have a look here. March is still a summer month, and we're still making the same sales we said we would make. But have a look in April here. Our sales are dropping by 20%. In other words, 5,600 Rand sales as opposed to the 7,000 Rand on the previous month, which was March. Have a look at that formula there. It's the March figure multiplied by 0.8, which gives us 20% of our sales. So we're making 5,600 Rand as opposed to the 7,000 Rand sales. The cost of sales will come down, of course, because we're selling less hot dogs and selling less hamburgers. So that also comes down. But have a look now at our gross profit when we come down here. It too will come down, all right, to 3,339 Rand. And further down the line, the fixed expenses stay the same. Bear in mind, they haven't changed. We've still got to pay the store operator, and we've still got to pay the bank the loan. And we're now making a loss of 188 Rand. Now, have a look at our cash flow now. We carried forward from March 7,941 Rand. Okay, there it is there at the top of the cash flow spreadsheet. It's the opening balance. Our cost of sales came in, less hamburgers, less hot dogs. We still had the fixed expenses. They didn't change. Add our income, which is 5,600. It's a bit less than what it was. It's 20% less. And therefore, we've made a slight loss of 188 Rand, which carries forward through to the April month over here, or the May month. Can you see that going there? So this figure, 7753, which is our closing balance, carries forward to our next month, which is 7753 there as an opening balance. Okay, so my figures in red here are indicating where we've got 20% less sales in the winter months than we do in the summer months, for example. And there you can see them. And again, the 5,600, these figures carry on forward. But in October, we go back to that formula we had where we had the same sales as we did in this other summer months, such as January, February, and March. You can see 7,000 Rand again for sales. So if we go down here, assuming the same cost of sales, those things are changing variable costs all the time, against the fixed costs, which are our store operator and our bank loan repayment, we then come to a figure here where we've got a profit again of 647 Rand. So look at our cash flow from the previous month, which was where we had the weaker sales or the winter sales. We carried forward 6,814 Rand. And now in our new summer month, it carries forward to there 6,814 plus our little profit. We're going to show 7,461 in our bank. Now this figure of cash flow 7,461 should be what's in your bank. That's the cash flow. So let's look at the 12 months that you've been trading, assuming on this case study here. 647 Rand in January, profitability, and it went through to March. Those were the summer months. It didn't make profit in winter because your fixed overheads were too high or higher than they should be, or made a loss for that month, 188 Rand loss. And so it went for 6 months. And then in the summer months, October, November, December again, you were profitable by 647 Rand. So if we look at the total profitability for the 12-month period, we can sum those together, and it tells us that for the 12-month period, we've made a profit of 2,755 Rand. Now SARS wants his slice of the cake. Okay? At 28%, it's 771 Rand of the 2,785 Rand. There's the formula there. It's the sum of those, but it's in actual fact, it's the 28% of the 2,755. We'd have to pay that to SARS. That would give us a net profit for the year of 1,984 Rand. That's how much money we made, profit-wise, for the company, after tax. Now, let's look at return of investment, for example. Okay, we invested 25,000 Rand to purchase a machine, a stand, for example, a hot dog stand. So if we look at how much money we made as a profit at the end of the year versus how much we spent to make that profit, we would get a formula here where it says that the investment of 25,000 Rand, you can see it on cell C31 there, divided by the profit that we made for the year. In this case, 25,000 Rand divided by 1,984 Rand profit for the year, and we sit with a net operating profit, or a return on investment, of 8%. Bear in mind also, at the beginning of this module, if you put your money in the bank at 5%, it was risk-free. So you need to ask yourself, is 8% really worthwhile entering into this business model? Or could you sell more product? Let's have a little look at that, for example. In order to make the profit we showed just now, we had 350 units. Let's say that you could make 500 or 600 units. Let's put 600, for example. You determined that the market could handle 600 units by your research. That's 600 units of hot dogs and therefore 300 units of hamburgers. Let's go back to the return on investment now. And suddenly you're making 101% return on investment. That's pretty good, considering you could only get 5% in the bank if you invested your money in the bank as opposed to your business idea. So at 600 hot dogs and 300 hamburgers, you'd make a return of investment of 101%. Or, in money terms, that would equal 25,166 Rand. So in theory, you've grown by 25,166 Rand. It would be about time now to declare a dividend maybe, or you could take some of that money out, or use that money to purchase another hot dog stand. Cash this time, without having to borrow from the bank. I hope that all makes sense to you now, and you've got the time to go back at it, and the spreadsheet is available to you online. But what you could do is you could use the spreadsheet to try and work out what your market could handle sales-wise, the sales mix. Is it really realistic to be able to sell 600 hot dogs and 300 hamburgers? Fiddle with the hot dog figure and you'll be able to see what return on investment you get, and also whether that would be viable within the marketplace you're working with.